Okay, I make that 2:30 by my watch. So good afternoon, everyone, and a warm welcome to the webinar today entitled, What Does Your Pension Statement Really Mean? Well, I'll be shedding some light on the information contained within your recently received pension statements and hopefully enable you to gain a better grasp as to what your pension benefits will be in retirement and how you can go about saving additional money for your retirement in an extremely tax-efficient way by using a benefit that's exclusively available to you being LGPS members. So as you can see on the screen there, my name is Nick Pottinger, and I'm one of the retirement education specialists here at ABC Wise. And I've worked in financial services for over 20 years now. And the last 9 of those years, I've been working exclusively in the local government AVC sector, where I've helped thousands of people like yourselves understand what a great employee benefit the ABC is and how they can make the most of it to save extra money for retirement and potentially help them retire earlier. Few things to cover before we get underway today then. So the content of this webinar is provided for educational purposes only and does not constitute financial advice. And the information given is based on our current understanding of taxation legislation and regulations. Any levels and bases of and reliefs from taxation are subject to change. And tax treatment is based on individual circumstances and may be subject to change in the future. And investments can fall as well as rise, and past performance should not be used as a guide to future performance. And finally, the figures we discussed today are for illustrative purposes only and are not guaranteed. So what are we going to be taking a look at today then? Well, first of all, we're going to break down the information contained within your pension statement. There's a lot of information contained within these statements, which can sometimes make it a bit confusing to read and pull the relevant details from. So we'll take a look at a case study to break this information into bite-sized chunks to make it a bit easier to understand. We'll then take a look at what benefits you're entitled to depending on the sections of the LGPS you've been a member of and when you're able to take those benefits in retirement. And lastly, we'll talk a bit around about what your options are for increasing the benefits you receive in retirement by using a unique option, which is exclusively available to you, with you all being members of the LGPS. Okay, so first of all then, I want to introduce you to a colleague of yours called Sarah. So what we're going to do here is use Sarah as a case study where we can first of all break down how membership of the LGPS is accumulated in an easy to understand way. So when we do take a look at the actual pension statement in a few moments' time, you'll be able to see how the different segments of the pension statement correlate with the information we go through here. So Sarah's an employee and she's been a member of the local government pension scheme for quite a while, and her normal pension age is age 67, as her normal pension age is now linked to her state pension age. And when Sarah gets to age 67, it's estimated that her final salary will be just over £29,300 or so. So Sarah is someone that's been in the local government pension scheme for quite a long period of time, as I've mentioned. So she's built up membership in all the different sections of the local government pension scheme. And as some of you here today might be aware, the local government pension scheme has actually changed a number of times over the years. So let's see what Sarah's built up in each respective section of the LGPS. So the first section that Sarah's built up membership in was the final salary 80th section. And this was in operation up until the 31st of March 2009. And this section worked on the basis that for every full year of membership in this section, you would build up 1/80th of your final salary as an annual pension amount in retirement. And Sarah was a member of this 80th section for 1 year and built up £393 of annual pension income within this particular section. And it's also worth mentioning that within this section, you'd have also built up an automatic entitlement to a tax-free cash lump sum, which is 3 times the annual pension amount. And I'll go into a bit more detail on that in a few moments' time. But Sarah's also got 6 years of membership in the final salary 60th section of the LGPS, and this ran between the 1st of April 2009 to the 31st of March 2015. And this section is still calculated based on what your final salary is, but instead of you building up 1/80th of your final salary for every year of membership, in this section you are building up instead 1/60th of your final salary as an annual pension for every year in this section. So in this 60th section, you'd have actually been building up more annual pension in comparison to the 80th section, as if you imagine a cake being cut into slices, a cake cut into 60 slices is going to have bigger slices than a cake cut into 80 slices. It's important to note that there is no automatic tax-free cash lump sum being built up in the background on this 60th section. The automatic tax-free cash lump sum entitlement was something that only existed within the 80th final salary section. But Sarah was working full time over the full 6 years the 60th section was in operation, and therefore built up the full 6 years of membership. So 6/60ths of our final salary in this section, amounting to £3,142 of annual pension income per year there. But the vast majority of Sarah's pension benefits was actually built up in the career average revalued earnings section, also known or abbreviated to the care section. And this is the section that everyone here today, doesn't matter when you join the local government pension scheme, you'll now be an active member of this care section. And this section came into place from April 2015. And in this section then, for every full year of membership, you build up 1/49th of your annual salary within that year as an annual pension income for when you retire. So say, for example, your salary was £49,000 and you're working full-time over a full year. In the care section, you'd have banked £1,000 of annual pension income per year for yourself in retirement. So the difference then with a career average section in comparison to the two final salary sections that preceded it is that the career average section takes each year in isolation when calculating your retirement benefits, whereas the final salary sections calculate generally based on the salary that you end up finishing work on. One important thing to note here is that the career average revalued earnings section, as the name suggests, it is revalued each year in line with the consumer price index to ensure the 1/49th of your annual salary you're banking each year is going up in line with inflation and protecting the buying power of your eventual pension income. So Sarah ended up accumulating 18 years of service in this Care 49th section, which amounted to her having an annual pension of £10,742 there. And with all those sections added together, then it meant that Sarah's annual pension, with 25 years of LGPS membership spanning all three sections of the scheme, her total annual LGPS pension amounts to £14,277 a year. And she did also build up a small automatic entitlement to a tax-free cash lump sum of £1,106, as Sarah only had 1 year in that final salary 80th section. And some of you here today, I probably expect you would probably have far longer service than Sarah did in that 80th section. And as a result, you'll have a much larger automatic tax-free cash lump sum waiting for you when you retire. Okay, so we've just established then that Sarah's entitled to an annual pension amount of £14,277 and a small automatic tax-free cash lump sum in addition to that of £1,106. And on top of the benefits you can see on the screen there, Sarah will also be entitled to her state pension benefits in addition to those benefits you can see there. And a state pension is approximately just over £9,500 a year or so at the moment. Okay, so now we know what benefits Sarah's built up in each respective section of the local government pension scheme. Let's just take a look at her pension statement to see how this information is laid out for her there. Okay, so what you can see on the screen here then is an example pension statement for Sarah. And as you can see, there is a lot of information contained within the statement, and this information is broken down into different segments. Now, your pension statement may not look exactly like the one for Sarah here, and it might be that yours is presented in a slightly different way. But all the LGPS statements will contain the same basic information broken down into the various different segments. So what I'm going to do is I'm going to take you through each segment of this statement and break down the relevant information contained within them. Okay, right, so the first segment of the statement then contains your personal details. So you just want to make sure that your name, your national insurance number, and your payroll reference is correct by perhaps cross-referencing it with one of your payslips. Now, in the top right-hand corner, you can see it says last day of service. And this is where it will give you your normal retirement date within the LGPS. And that's now linked to your state pension age. So for some of you here today, it could be age 65, 66, 67, 68. In Sarah's case, her last day of service is shown as the 1st of April 2032, which is her 67th birthday, and this aligns to her state pension age. You can also see a section where it says final pay, and this is where it estimates the final salary you would be on at the point of leaving employment. And this is the salary that the statements will be using to calculate any benefits you may have built up within the final salary sections that ran up until the 31st of March 2015. And in Sarah's case, her pay is estimated to be £29,311. Now, below that first segment of the statement, then you can see a box where it says pension benefits summary payable from the 1st of April 2032. And this is where it's going to give you a projection as to what your LGPS benefits will be at retirement at your normal pension age. And it does this by adding up all the sections of the scheme you've been a member of and up until the point of your point of retirement. So as we can see here, Sarah's annual pension before income tax or other deductions is coming to that figure we had a look at earlier of £14,277. So in this case, it's all the membership she's already built up in the LGPS within the final salary 80th and 60th sections, along with the service she's built up so far in the career average 49th section, and also factoring in the projected future service she'll have in that 49th section until her normal pension age. And that's what makes up that £14,277 projected annual pension figure there. Now, the next box underneath shows us Sarah's retirement grant, which is the automatic tax-free cash lump sum you're entitled to. So if you've got any membership within the local government pension scheme in the final salary 80th section that ran up to the 31st of March 2009, you'll have some form of retirement grant. And as we know, Sarah had 1 year of membership within that 80th final salary section where she's entitled to a £1,106 automatic tax-free cash lump sum. So if you don't have any membership within that 80th final salary section as you join the LGPS after the 31st of March 2009, you will either not see that retirement grant box on your statement, or it will instead be showing as 0. And then the last box of this segment on the statement, then it shows the annual survivor's pension. So this is the part that details what annual pension amount your spouse or partner would be entitled to if you were to die whilst in retirement and leaving a dependent survivor. So in the event of Sarah's death, where if she was to pass away before her spouse or partner, in this example, we can see that her survivor's pension pays out an annual pension figure of £4,634. Okay, so let's move on to another part of the pension statement now. Now, on this segment of the statement, you will see the service box, and this is where it details the amount of service you've built up in each respective section of the LGPS. So it has been broken down between the 80th, the 60th, and the career average sections. So we can see here that Sarah has service of 1 year and 0 days in that 80th section. She had the full 6 years and 0 days in the 60th section. And then it's showing that by the time Sarah reaches her normal retirement age of age 67, she'll have 18 years and 0 days in that career average care section of the scheme. And then the box below titled Calculation of Benefits Annual Pension breaks down how her predicted annual pension at retirement age is calculated. So Sarah had 1 year in that 80th section of the LGPS, which gives her that annual pension amount of £393 there. She also had the 6 years in that 60th section, which we can see gives her that annual pension amount of £3,142 there. And as we know, the majority of Sarah's pension benefits were built up in the career average section, where she had 18 years of service and built up a further £10,742 of annual pension income there. So when Sarah gets to her normal pension age, which is age 67 in her case, her total local government pension, with all those sections combined, is that figure we showed on our case study earlier, £14,277 a year. And remember, that will be in addition to whatever state pension benefits she'll be entitled to too. Okay, so let's move on then to the final segments of the pension statement now. So you can see a box here titled Annual Survivor's Pension. And again, that's what your surviving partner or spouse will be entitled to in the event of you passing away whilst in receipt of your LGPS pension. And in Sarah's case, as we know, her survivor's pension amount would be that £4,634 figure, and they would be in receipt of that until their death. Now, you've got this final box where it breaks down some information relating to the overall government limit in place for everyone in the UK, and is what they allow you to build up it as a total cash equivalent value in all of your pension plans over the course of your lifetime before you face punitive tax. And this is called the lifetime allowance. Now, the lifetime allowance is currently £1,073,100. And that's quite a high amount, so a nice problem to have, I suspect, for many of us. But your local government pension scheme is one of the best pension schemes in the UK, and it can eat up quite a bit of your lifetime allowance, especially if you've been a member of the scheme for quite a substantial period of time. Now, in Sarah's case, the predicted value of her LGPS benefits at her retirement age is £286,646, which is using up 26.71% of her £1,073,100 lifetime allowance. So in Sarah's case, she's got plenty of scope before she comes close to getting to that maximum amount. But if you take a look at your statement and see that you're going to be using up more than Sarah, maybe around 80% or over of that lifetime allowance, it would be something to be careful about and make sure that you have plans in place to not overfund your pensions, because if you do, you can face some pretty excessive tax charges. Okay, so what we've just broken down there then is how your LGPS benefits are calculated and how the information is laid out on the annual benefit statements you receive from your main local government pension scheme. And I hope that's made things a little bit clearer for you. So when you next take a look at your statement, you can see how your benefits are built up and how they've been calculated to give you a better understanding as to what your pension benefits are predicted to be at your retirement. Okay, so let's continue then with our case study and see what Sarah's plans are for her retirement. So Sarah's decided she doesn't want to work until her normal pension age of age 67 and would instead like to retire at age 64 instead, as she feels she would like to retire a little bit earlier to allow her to enjoy the finer things in life, such as spending more time with her family and being able to go on some holidays while she's still at an age where she's physically and able enough to fully enjoy them. Now, you'd think that just going 3 years early wouldn't have too much of an impact on Sarah's annual pension of £14,277, right? I mean, in reality, that's actually only 36 paydays early she's looking to go there. Well, in actual fact, by Sarah retiring just 3 years early and accessing her local government pension at age 64, it actually wipes off over £4,000 of her annual pension income, which is a massive hit for her to take. So why is there such a big hit to Sarah's annual pension amount then? Well, it's because, first of all, the number of years of membership in the pension scheme is reduced. So Sarah will be missing out on 3/49ths of her annual pension by going 3 years early. And secondly, because the LGPS will apply what's called an actuarial reduction to our annual pension amount. As the pension scheme knows, they will now need to pay Sarah a pension for 3 years longer than they would have needed to if she'd retired at age 67. And it's that double whammy impact, really, of Sarah reducing the years of membership in the local government pension scheme and the actuarial reduction applied by a pension scheme that causes that significant impact to Sarah's annual pension amount. And remember, it's not just 1 year that Sarah's going to have to deal with this £4,000 reduction. This has actually set the tone for the rest of her retirement. And if Sarah's going to have a long and fruitful retirement, she could be living for another 20, 25 years perhaps. And that's a lot of money per year that she'd be missing out on. Now, there might be some very good reasons as to why Sarah does want to retire at age 64, but she would need to think long and hard about as to why she does want to retire early, as £10,253 a year is a lot less than the £14,277 a year she would have been entitled to if she didn't retire early. And some of you here today might be thinking that you would like to retire early. But how do you feel about having that significant impact on your annual pension amount? How important is it for you to be able to retire early? And if it's that important, are you prepared to do some additional saving to make it a reality? So we've shown earlier today then that if you have any membership in that final salary 80th section of the local government pension scheme that ran up until the 31st of March 2009, you'll be entitled to an automatic tax-free cash lump sum of 3 times the annual pension amount you're due from that 80th section. And if you have no membership in that final salary 80th section, you would have 0 entitlement to an automatic tax-free cash lump sum. But that doesn't mean that you can't decide to take tax-free cash from your main local government pension scheme when you retire. So whatever pension scheme you belong to now in the UK, you are allowed to take up to 25% of the benefits out as a tax-free cash lump sum. So when you get to retirement, you've got the option that you can decide to exchange some of your yearly annual pension income in retirement to take more tax-free cash, which sounds like a good idea, doesn't it? Everyone likes the idea of getting money on a tax-free basis. But what happens to your local government pension if you did decide to take tax-free cash from it? Well, let's have a look here. So you have your annual LGPS pension amount in retirement, whatever the amount is in your case, and you can decide to commutate £1 of your annual pension income in exchange for £12 of tax-free cash, which on the face of it there doesn't sound like too bad of a deal. But in reality, that's a whole £1,000 of guaranteed pension income per year that you're losing for every £12,000 of tax-free cash that you take. So you'd actually need to think long and hard about this, because if you think about the average life expectancy and how long we all might expect to be around in our retirement, it might not work out to be such a good deal. And that's because that £1 of annual pension income that you're giving up is absolutely worth its weight in gold. And that's because not only is it guaranteed monthly income paid year in, year out until you die, but crucially, it's index linked income that you're giving up. And that £1 isn't going to stay as a pound. It's going to go up and up by whatever the CPI is. So if you leave that £1 of annual pension income alone, in all likelihood, you're going to be very glad that you made that decision, as you now have an income that does have the benefit of having that index linking attached to it, rather than the quick win of getting £12 upfront of tax-free cash. So the question that you really need to pose when you get to your retirement is, should you take your full annual pension amount that you're eligible for, or decrease that annual pension amount that you're due to receive by taking a larger or more of a tax-free cash lump sum? So if we take Sarah as an example here, we know that Sarah's standard LGPS benefits, where she doesn't give up that income to take more tax-free cash, she's entitled to that full annual pension amount of £14,277 a year. And remember, that pension income is paid year in, year out on a monthly basis for the rest of her life. And not only that, it's based on those CPI increases. And the index linking element, as I've already mentioned, is one of the more valuable parts of your LGPS. And just looking at this year, where CPI is currently running at 9.9% for August, and is expected to be going up further still as we get into the latter part of the tax year, you can really start to see the value of that index linking and the value that it provides to your LGPS benefits. And not only that, but remember, if you die whilst in retirement, your pension does not die with you, as there is a surviving spouse or partner that will be entitled to a portion of the pension that you were receiving until they pass. And again, this spouse or partner's pension will also be increasing in line with CPI too. And as we've seen with Sarah, this amounts to that figure of £4,634 a year. Now, when it comes to exchanging annual pension income for tax-free cash within the LGPS, there is always an upper limit, a maximum amount that you're allowed to exchange for tax-free cash. Everyone will have different maximum amounts, as you're allowed to take a maximum of 25% of the total capital value of the LGPS benefits as tax-free cash. So in Sarah's case, the maximum amount that she's able to take back as a tax-free cash lump sum from her main local government pension scheme, based on that annual pension income of £14,277 a year, is £94,074. Now, if Sarah actually did decide to convert her annual pension income on that £1 annual pension income to £12 commutation exchange rate factor and take the maximum tax-free cash of £94,074, she would do some considerable damage to the amount of annual pension income she'd be in receipt of in retirement. It would actually mean that Sarah's annual pension amount would decrease by a massive £7,839 every year. And you could actually look at it along the lines of, if she lives for longer than 12 years in retirement, she'd have been better off leaving that standard pension income alone as it was. So when we take a step back and examine what this would mean for Sarah, it would mean that Sarah's reduced annual pension amount would have plummeted all the way down to £6,438 a year from that £14,277 a year she would have been receiving had she left her annual pension income intact and not converted the annual pension for tax-free cash. And remember, the higher the annual pension income is, the more it's going to grow in actual monetary terms due to that linkage with the consumer price index. So coming back to that question then that you can see at the top of the slide there about whether to take more tax-free cash from your local government pension at retirement. Well, it's rarely the correct thing to do from a financial perspective, and usually far better to leave your annual pension income alone, where you're going to carry on benefiting from the full annual pension amount that you're eligible to receive in retirement and have the index linking attached to it, attached to that full pension amount too. The only way you could really see commutation to tax-free cash as a good deal is if, unfortunately, you're not going to be around that long in your retirement. So in Sarah's case, then, she decides to leave her pension income as it is, the amount of £14,277 a year, and not convert any of that pension income to tax-free cash. But Sarah, as an LGPS employee, does have another option that allows her to build up an additional tax-free cash lump sum for her retirement that doesn't have any detrimental impact on her valuable main scheme index-linked local government pension. So with a local government shared cost AVC, she can save additional money for retirement in a remarkably tax efficient way, where she saves on tax and national insurance every time she contributes into the arrangement, and she is able to take that whole AVC pot of money she's built up all back as a tax-free cash lump sum, as long as she takes the AVC at the same time as she takes her main local government pension scheme benefits, and as long as it's within certain limits. And everyone here today, as you're all current LGPS members, you are also able to make use of the shared cost AVC arrangement that allows you to build up an additional pot of money for your retirement that you can potentially take all back as a tax-free cash lump sum, a benefit that's exclusively available to you with you all being members of the LGPS. So by saving into a shared cost AVC, you're getting the best of both worlds, where you're able to take your full annual unreduced LGPS pension amount and also take a tax-free cash lump sum in addition to that too. Now, this tax-free cash lump sum that you can build up within an AVC can come in very handy if you're someone who just wants to have an additional pot of money in retirement to spend on holidays or luxury purchases, or perhaps just having the peace of mind and having a chunk of money in your bank account for rainy days to supplement your annual pension income you'll be receiving from the LGPS. But not only that, the shared cost AVC can also help you facilitate an earlier retirement too. So let's take a look at what Sarah's plans are for her retirement then. So we know that most people would want to retire earlier than their normal pension age, which is now aligned to your state pension age. So how will saving into a shared cost AVC help you do that? As I say, let's have a look at Sarah here. So Sarah reaches the age of 64 and she decides to retire 3 years earlier than her normal pension age. And due to this, she accepts that her benefits will be lower because she'll have fewer years in the local government pension scheme, and lower still due to the actuarial reductions that are placed on her pension. So what Sarah did is she contributes into the shared cost AVC in the extremely tax efficient way we know about, by getting that double tax break on her income tax and national insurance. And then she takes the whole AVC pot of money she's built up all back as a tax-free cash lump sum. And Sarah takes that AVC at the same time as she takes her main local government pension scheme benefits. And Sarah uses the tax-free cash lump sum from the AVC to help her bridge the gap between retiring early and getting a state pension at age 67. So ultimately, then at age 64, Sarah has a tax-free lump sum to do the things she wants to do when she has the good time and good health to do them, whether that's going on holidays, replacing the car, spending more time with the family. She's now got control. So that's an example there of where Sarah wanted to take the whole AVC pot of money she'd built up all back as a tax-free cash lump sum at the same time as she takes her main local government pension benefits. But what if she wanted to access her AVC pot of money she'd built up before she took her main local government pension? So this is a relatively new option that became available when pension freedom rules came into place in 2015. So as long as you're over the minimum retirement age, which is currently age 55, you've got several options available to you. You're no longer forced to buy a financial product such as an annuity of your pension pots, and you've now got the freedom to leave the money invested and withdraw the funds as and when you want to. So as we know, Sarah wants to retire 3 years early at the age of 64. And in this particular example, she's decided to use the AVC to bridge the gap between her leaving work at age 64 and then accessing her main local government pension at age 67. And by doing this, it means that Sarah will not have an actuarial reduction on her main local government pension scheme benefits, and therefore preserve some of that worth its weight in gold index-linked pension income. So she's basically decided to live off of her AVC pot between the ages of 64 and 67. Now, we have made an assumption here that Sarah's managed to build up a fairly sizable pot of money in her AVC arrangement, amounting to £48,000. And the reason we've used this assumption will become a little bit clearer in a moment, but £48,000 is a very attainable figure for Sarah. And to give you an example, if she was making a monthly £250 AVC contribution for around 13 years or so, it would mean that Sarah, in all likelihood, would have built up an AVC pot in and around that £48,000 figure. Okay, so Sarah gets to age 64. She stopped work. She's left her main local government pension scheme where it is. She doesn't access it. She defers taking that until age 67 to avoid the actuarial reductions. And she decides to take withdrawals directly from her shared cost AVC. And this is where Sarah's got a little bit clever as to how she accesses the money in her AVC. So essentially what Sarah does is, in the first year of leaving work at age 64, she withdraws £16,000 directly from her shared cost AVC in that first year of leaving work. And when Sarah takes a £16,000 withdrawal from her AVC, 25% of it is automatically tax-free. So £4,000 in Sarah's case is automatically tax-free. Now, you are allowed to earn a certain amount of money per tax year before you're due to start paying tax. It's called the personal allowance, and this tax year is typically £12,570 that the UK government allow you to earn before you're due to start paying tax. So once Sarah's taken a once Sarah's taken £4,000 of her £16,000 withdrawal automatically tax-free, it leaves her with £12,000 of her withdrawal that she may have to pay tax on. But in Sarah's case, she's not in receipt of any other forms of income, and therefore the £12,000 can also be taken tax-free retrospectively too. And Sarah does this exact same thing for each of the 3 years she's not working, at age 64, age 65, and age 66, where in each of those years she takes a £16,000 withdrawal, £4,000 of it automatically being tax-free, and the other £12,000 falling under the personal allowance threshold, so she can retrospectively claim the tax she pays back on that as well. So to sum up here then, Sarah's done a great job in planning for her retirement, as her AVC pots allowed her to retire 3 years early at the age of 64 by bridging the gap between her leaving work and then accessing her main local government pension and state pension at age 67. And she still managed to take the whole pot of money she'd built up all back tax-free. So essentially, the bigger your AVC pot is, the earlier you can retire and bridge the gap between you accessing your main scheme benefits and incur less or no actuarial reductions on those main scheme benefits too. And in Sarah's case, her annual pension she's entitled to at age 67 by deferring those benefits is £12,905 a year, which is quite a bit more than the £10,253 she would have been entitled to if she had accessed her main scheme local government pension at age 64 and had incurred those actuarial reductions. Okay, so just some conditions and considerations in relation to the shared cost AVC. So you do have to be an active member of the local government pension to be able to make contributions into the shared cost AVC. What I mean by active member is that you're currently making contributions into your main local government pension. As long as you're doing that, you can make contributions into the shared cost AVC. Now, you can't pay an amount into the shared cost AVC that will take you below the national minimum living wage requirements. And don't worry about that too much, because your employer will do a double check on your application to make sure that whatever amount you are looking to pay into your shared cost AVC is not taking you below those national minimum living wage requirements. And what I will say as well is there is quite a useful calculator on our website where if you wanted to find out what the maximum amount is that you can pay into an AVC on, say, a monthly basis and remain above those national minimum living wage requirements, you can pop in details to a calculator on our website, such as what your salary is and how many hours per week you're currently working, and it will give you that upper limit as to what you can pay in and remain within those limits. But as I say, your employer will be double checking your application in any case for that. You've also got the lower earnings limit to consider as well. So if you were sacrificing enough from your salary over the full course of a tax year that it was actually reducing your salary below £6,396, that's where you'd be going below that lower earnings limit. And when you do that, you start to potentially maybe start to see an impact in relation to the state pension benefits you're entitled to. So we'd say anyone that is perhaps looking to set up a shared cost AVC or is already paying into one, you want to really make sure that whatever you're sacrificing from your salary to pay into the shared cost AVC over the tax year is not taking your total salary to below that £6,396 figure, and therefore would not be having any impact on your state pension benefits you're entitled to. We've also got the general government restrictions on what they allow you to pay into pensions to consider as well. So you've got the standard annual allowance, and that's the amount the government allow you to pay into pensions within a tax year and receive tax relief on. It's typically £40,000, the annual allowance, although it could be impacted if you've previously drawn on a pension, because you can sometimes trigger what's called the money purchase annual allowance, and that's where HMRC put further restrictions on what you're allowed to pay into money purchase pensions going forward and allowed to receive tax relief on. And currently that money purchase annual allowance is £4,000 a year. You've also got the lifetime allowance, which is the amount that the government allow you to hold in all of your pensions over the course of your lifetime before facing punitive tax. As I've already mentioned earlier on, it's quite a high amount, 1,073,000 or so. So a nice problem to have if you've got that issue, but certainly something you'd want to keep an eye on if you are getting up towards the upper end of the scale there. With the shared cost AVC, you've got the freedom to change your contributions at any time. You've got that flexibility there, so you can increase or decrease whenever you want to whatever you can afford to pay in. And lastly, opting out or leaving employment. So if you were to opt out of paying into your main local government pension or leave your employer, you're no longer going to be an active member of the main scheme, and therefore you can't make any further contributions into the shared cost AVC. So any money you've already got in the shared cost AVC would remain invested in the fund or funds of your choice until you decide to access the AVC benefits in retirement. Okay, so to recap then, we've established that you can build up this pot of money within a shared cost AVC that you can potentially take all back as a tax-free cash lump sum without it having any impact to your valuable main scheme local government pension. And you get to make income tax and national insurance savings on every contribution. But let's just bring this to life a little bit here in terms of what these tax and national insurance savings will look like by using an example. So if you're on a salary of around £30,000 a year, you would be an intermediate rate taxpayer, paying tax of 21% on a proportion of your earnings and national insurance at 13.25% on any of your earnings above £12,570. So if you're someone in a similar position and wanted to save £100 a month into a shared cost AVC, it would actually only cost you £65.88 from your net pay to do it. So that's a saving there of £34.12 each and every time you make a £100 contribution into the shared cost AVC, purely based on the tax and national insurance savings you're making as the contribution goes into the arrangement. And if we take a look at what that kind of uplift equates to, that actually amounts to a massive 51.79% uplift to your savings as soon as the money goes into the shared cost AVC. And if you're a 41% taxpayer, the savings are even greater still, with a potential uplift in the region of 79% on any money you're due to pay 41% tax on. Now, some of you here today might be currently saving money into a savings account or a cash ISA, where at the moment you'll probably be lucky to be getting around 2 to 3% interest on your savings. With the shared cost AVC, you'd be benefiting from that huge initial uplift as the money goes into the arrangement, and really does allow you to save money for retirement in the most tax efficient way possible. Now, I appreciate the AVC is a pension arrangement, and therefore you can't access the money in a pension arrangement until you're over the minimum retirement age, which is currently age 55. But the comparison there is pretty stark when you're looking at the savings you could potentially be making within a shared cost AVC in comparison to other savings vehicles you've got access to in the marketplace. And this is what your employer set up for you, the ability to save money from your salary, allowing you to save on tax and national insurance on your contributions, and potentially be able to take that whole AVC pot of money you've built up all back as a tax-free cash lump sum at retirement with absolutely no detriment to your main LGPS benefits, which is an absolutely fantastic benefit for you. Okay, so how would you go about setting up a shared cost AVC then? Well, the first step is to go to our website, avcwise.co.uk, and log into your account. And on the home page, scroll to the bottom of the page and you'll see the application buttons. And you just need to click on the new application button. You then just need to enter your details and select the fund or funds you want to invest in. And within the application, you'll have the opportunity to download the fund guide document. And this will give you details about all your available fund choices, where you can read through that and come to a decision as to where you would like to invest your AVC contributions. Now, the AVC is an investment-based product, and as with any investment, you could get back less than what you've paid in, but all the funds are there with the intention of increasing your AVC pot of money on top of what you've already paid in yourself. And you've got the flexibility to change your AVC contribution amount to whatever you can afford, and you can also alter your fund choice too. So you're not tied into the amounts or the fund choices you put on your initial application, as you always have the ability to change that as you go. Then once you submit your application, then that will then make its way to your employer for them to do their checks on. And on the basis that it's accepted by your employer, your AVC will then be set up with your AVC fund provider, and your AVC contributions will then start to be taken from your next available payroll, which is typically the following month. Now, if you're someone here today that's already currently saving into a shared cost AVC with us here at AVC Wise and want to amend your AVC contribution amount, it's a similar process. Again, you'll just need to go to our website, avcwise.co.uk, and log into your account. Head to the My Shared Cost AVC page and click on Amend Contribution Amount. Enter the new total monthly amount you want to contribute into your shared cost AVC. Your employer will then verify that amendment application, and your amended AVC contributions will then start to be taken from your next available payroll, which, as I say, typically the following month. Now, we appreciate that some of you may need some extra help when it comes to setting up a shared cost AVC. So you do have the opportunity of booking a one-to-one meeting with us, and that might be with myself or one of my fellow retirement education specialists here at AVC Wise. And the meeting will last up to around 20 minutes or so, and it takes place on Microsoft Teams. And it's where we can give you a helping hand to set up your shared cost AVC. And we can look at things such as working out the maximum amount that you're allowed to hold in your AVC and take all back as tax-free cash, or looking at what you can pay in to maximise your tax and national insurance efficient contribution. And really just ensuring you're making the most of the unique opportunity the shared cost AVC presents. Now, I will stress this option of a meeting is really only available at this moment in time if you're ready to set up a shared cost AVC now, if you're looking to amend your AVC contributions now. I would say if you're not looking to do that at this point, hold off booking a meeting with us, and instead just come back to us at a future point when you are either in a position to apply or to amend your contributions. But if you are ready to apply now or amend your contributions now and would like that helping hand before you do that, send us an email at support@avcwise.co.uk. We can then get a link across to you where you can book in a meeting at a convenient time and a date for you. Now, some considerations here for us to be able to help you at this meeting. Please do ensure that you have access to an LGPS projection to your desired retirement age. If your annual benefit statement has a projection for an age later than your intended retirement age, you can always log into your LGPS self-service portal to get a projection to your desired retirement age there. Also, if you've already got an AVC arrangement already in place, try and get an up-to-date valuation of what your AVC pot is currently worth. And we'll also need you to have access to an up-to-date payslip. And please also do consider what you can afford to see less in your take-home pay each month too. As you can see there in the bottom left-hand corner of the slide, we're not providing any financial advice or investment advice at the meeting, but we can give you factual information and help you on your way to applying for the Shared Cost AVC. So just to reiterate, if you're ready to apply now or want to amend your Shared Cost AVC contributions now and would like that meeting with us before you do that, send us an email to support@avcwise.co.uk and we'll get that set up for you. Okay, so do just want to mention, please do have a look at the Knowledge Hub on our website, avcwise.co.uk, because there specifically is a very useful tool available there, the AVC Wise calculator, that allows you to find out how much an AVC contribution would cost you from your take-home pay, and can also try and give you an idea as to how much your AVC pot could be worth in retirement. As far as further resources go, after today, the first port of call for you will be to take a look at your annual pension benefit statement that's issued every year. You should also be able to log into your pension fund website to view your latest pension position there as well. We've also got that website, lgpsregs.org, and that's a useful resource if you want to find the definitive information about your main local government pension scheme. It is a generic website, but it does go into a bit of detail about how your main local government pension scheme works. And as I say, we'll stop for questions in a moment, but just before we do, I just want to run through some useful pointers here. So, as I mentioned, if you would like to set up an individual meeting with us in relation to perhaps setting up a shared cost AVC or to amend your existing shared cost AVC contributions, send us an email to that email address at the top there, support@avcwise.co.uk, just requesting that individual meeting. Got a live chat facility on our website where you can get a response to your questions in real time if you're looking for a quick answer to a question you've got. Or if you prefer the more traditional contact method, you can give us a call on that telephone number there. We're open, typically speaking, between 9 a.m. to 5 p.m. weekdays. And as I just mentioned, please do have a look at the Knowledge Hub on our website, which has plenty of useful information and tools on in relation to the Shared Cost AVC. And you can also find your organisation-specific frequently asked questions document within your AVC Wise account. And that's where we've compiled the A to Z of every question we've ever been asked about the Shared Cost AVC in one handy document. And lastly, if you're looking for more details about how your main local government pension scheme works, you can find that on that website at the bottom there, scott.lgpsregs.org. Okay, right. Well, let's go over to Barry then, my colleague Barry, and see if there's been any questions. Any questions, Barry?
Hi, Nick. Yep, we've had quite a few questions through. The first one we'll cover off. A good question from Gordon. So just asking, doesn't salary sacrifice reduce your salary available to your local government pension? So Gordon, in answer to that, your local government will use your notional salary, which is the salary before any salary sacrifice is made when it comes to calculating the benefits on your main scheme pension. So the AVC won't damage your main scheme pension. Okay. Yvonne's asked a question. Let's put that in the room. Is it possible to take the shared cost AVC earlier than your standard pension? So Yvonne, in short, yes, it is possible to do that. So currently you can access the AVC from the minimum retirement age, which is currently 55. However, if you're looking to take the AVC all back as a tax-free lump sum, you'd need to take it at the same time as your main scheme pension, and it would need to be within those limits that we mentioned earlier. So it is possible to take it earlier than your main scheme pension, as long as you're over the age of 55. But by doing that, you would need to separate it from your main scheme pension, and then you'd be limited to only taking 25% of the AVC back.
Actually, Barry, let me just step in there, because actually the Scottish local government AVC scheme works in a slightly different way to the England and Wales and the Northern Ireland one. So actually, if you wanted to access your AVC before you take your main local government pension, yes, you can do that. And you don't actually technically need to transfer it out to another arrangement like you would need to do if you're an England and Wales or Northern Ireland local government AVC member, because you can simply just take withdrawals directly from your AVC. Okay. And each time you take a withdrawal from your AVC, 25% of it would be automatically tax-free. the rest of it would be added on to any other income that you're earning in that tax year to determine what tax you should be paying on it. But yes, you can access it early. As long as you're over that minimum retirement age of age 55 currently, you can take direct withdrawals directly from your AVC, because it is a Scottish local government AVC, and they allow that.
Thanks, Nick, for clarifying there.
No problem.
Another question we've had through, so one we get quite often: what happens to the AVCs if you were to die? So quite simply, Shona, what would happen is your AVC pot would go to whoever you have on your nomination form with your employer there, and that would typically be paid as a tax-free lump sum. So we'd always recommend that if you can keep your nomination form up to date with whoever's on that, then that's what would happen to the AVC in event of if you were to die. Okay, let's have another look. So George has just posed the question as well. When setting up the shared cost AVC, I choose which funds to invest in. Can these be changed at any time, or will it remain invested in that fund for the life of the shared cost AVC? Well, George, one of the key benefits of the shared cost AVC is the flexibility. So as Nick had mentioned, you can vary the amount that you're contributing in. You can actually change the fund choices of the AVC as well. So that's something you do directly with the provider. So whether it's Prudential or Standard Life or whoever your provider is, whatever you put on your application form, you're by no means locked into staying within that fund or funds. You can change those at any time, and you just do that by getting in touch with the provider, and they could then change that accordingly for you. Let's have a look. Any other questions we've had come through? So Kate's said she's tried to look at her annual statement. You were able to log in, but there was no link to the statement, and the information fields were blank. So I'd probably suggest in that instance, Kate, going back to your main scheme who have actually sent that, in case there's been an error, because normally you should have some information on there. If that's who it's come from, I'd probably try and get back to them directly and just see what's happened with that for you. Let's just have a look if there are any other questions that have come through. Okay, Nick, you might be able to see some questions.
Yeah, I can see some other questions. Let's pull some of these other questions across here. So let's have a look at this one first of all. Let's get this across. So Gordon said, I've moved between LGPS and NHS Scotland pension scheme from 1989. Will I get final salary for the applicable years? I forgot to add, I've transferred all benefits from my current employer to both pension schemes. So Gordon, what happens is when you're in a public sector pension scheme, when you join a new scheme, so you say you join the local government pension scheme, there's something called the transfer club. Where you've got a year or so to transfer any existing benefits you've built up within, say, the NHS into the main scheme. Now, those benefits are broadly carried across on the same basis, but what I would say is your statement should break down the amount of what service has been allocated for you in relation to transferring those benefits in. So whatever you're saying on your statement should incorporate anything that you've transferred across from that NHS pension. And if you want any further clarification on that, I would say speak to the main scheme, because they should be able to give you further details on that. Gary has asked, can you confirm that with the care system is revalued for 21-22 at current inflation running at approximately 10%, and how is the value of the benefits calculated? Yes, Gary, so essentially, you know, the career average revalued earnings is to give it its full name, is the scheme everyone's in at the moment. It's been in place since April 2015. And yes, you're banking 1/49 for whatever your annual salary has been within that year. But because, you know, as the years go by, that annual amount that you would have banked would be going down in kind of monetary value terms. So yes, they do uprate it by CPI every year. So yes, you know, if you're looking at this tax year, obviously the new figure was released this morning, and it's roughly around 10% at the moment. They're probably expecting that to perhaps go up a tad as well by the time we get to the end of the tax year, but they'd be revaluing that at the end of each tax year effectively. Gary has asked, what is the annual rate for an actuarial adjustment? So this is where we were saying, you know, if Sarah, she decided to retire 3 years early, she would have an actuarial reduction on her pension. Now, it's roughly around 4 to 5% a year. All right, Gary. So if you retire a year earlier than your normal pension age, it's roughly around a 4 to 5% reduction on that annual pension income that you'd be due to receive. So if you retired around 10 years before your normal pension age, you can see that would tally up to quite a large reduction in around kind of 48, 50% or so. So That's the kind of rough rate of actuarial adjustment. But again, I would advise you, if you are looking to find out, potentially what your pension would be if you were to leave early in your normal pension age, if you log into your main local government pension scheme website, there is a calculator there where it usually says benefit projectors, and then you've got a section where it says voluntary retirement. If you click into that, you can put in a date that you might be looking to retire at, and it will actually factor in any kind of actuarial adjustment to give you a better understanding as to what your annual pension would reduce to. And Gary has also asked, how is Sarah's £94,074 calculated? Is it 25% of 14,277 times by 12? Well, Gary, it's a calculation in terms of the value of the main scheme benefits. If you're looking to work out what the maximum is you're allowed to take back tax-free cash by giving up pension income at that 12-to-1 exchange rate. So to work out the value of your main scheme benefits, you'll take the annual pension that you're expecting to receive in retirement, the full amount, in Sarah's case, that £14,277 figure. You'll times it by 20. It's always by a factor of 20. So whatever your annual pension is predicted to be, you times it by a factor of 20. You then add on to that any automatic tax-free cash lump sum you're entitled to if you were a member of that final salary 80th section that ran up until the 31st of March 2009. That then gives you the total value of your LGPS benefits. And if you divide that figure by 4, that is essentially giving you the maximum you're allowed to take as tax-free cash from the main scheme by giving up that pension income. But remember, you are giving it up at that 12-to-1 factor rate, which is often not looked upon that favourably in terms of a good deal. Gary has asked again, can all the AVC be taken out at any time with an upper limit of only 25% tax-free? Is a tax-free allowance of 25% apply for each financial year? That's a common question we get there, Gary. Can you keep on taking 25% from a pension every tax year? HMRC would say you can take 25% of the benefits from a pension tax-free, and usually that's a one-time point access in terms of tax-free cash. I know we used the example of Sarah earlier where she took withdrawals directly from her AVC. Now, if you're taking withdrawals directly from your AVC, 25% of any withdrawal you're taking is tax-free. Okay, so 25% of any withdrawal you're taking, doesn't matter what tax year you're in, any withdrawal you're taking is going to be tax-free. The rest of it is added on to any other income that you're earning in that tax year to determine what tax you'd be paying on it. If you want to take the AVC at the same time as you take your main local government pension, you want to take it all back as a tax-free cash lump sum, which is in theory possible as long as it's within certain limits. That's where you've just got that one-time point access where you can potentially take it all back as a tax-free cash lump sum within certain limits. Yvonne has asked, is the LGPS planning to move the investment funds away from carbon intensive industries in line with the net zero aspirations of the government? Oh, that's a great question, Yvonne. I mean, essentially, your AVC provider, be it Prudential or Standard Life, is appointed by your local government pension fund. Whoever your local government pension fund is, in your case, says, well, it's either Standard Life or Prudential that have the ABC arrangement. Now, it's up to Standard Life and Prudential as to what funds they offer. I know that Standard Life and Prudential do have some funds that, for example, Prudential have what's called the Positive Impact Fund that have certain criteria that the funds have to meet. And also remember, a lot of the funds that you're investing in, they aren't investing into stocks and shares. A lot of people assume when you talk about investments that you're purely investing into company shares where you've got that kind of ethical criteria to hit. But actually, with the ABC, you could be investing in funds that are investing into, say, commercial property or government bonds, which are loans to the government, known as gilts, or loans to companies. You could have funds that are investing into cash type assets. So it's really typically, when you're looking at funds in higher risk and medium to high risk, and potentially multi-asset funds in medium risk and lower to medium risk that may have an element going into company shares. But ultimately, it's down to your pension fund, Yvonne, as to what funds Standard Life or Prudential offer for you to be able to invest in. Heather has said, in relations to the current annual survivor, what happens to your pension if you die within a few months of retiring? Does the amount increase, or is the pension lost? Heather, that's a good question. I mean, ultimately, if you were to die a few months into retirement, you're going to have that survivor's pension amount paid out. As we talked about earlier, it's roughly around a third of your annual pension income, to give you a rough idea. But sometimes local government pension schemes can issue a kind of a cash grant, as it were, where a lump sum is paid out, perhaps within the first 10 years of you dying. I would say check that with your main local government pension scheme, because they should be able to give you further information if that is the case. Kate has said, how do I find my LGPS annual statement? Well, Kate, that should be sent to you every year in the post, as far as I understand. I think maybe some local government pension funds have converted it all to online. Maybe that's the case for yourself. But ultimately, if you were to go onto Google and type in the name of your pension fund, whether that's Strathclyde Pension Fund, North East Scotland Pension Fund, whoever your pension fund is, type that into Google. It should take you to the website for that, for your particular pension fund, and you can log in there to view your pension statement there. Kyle has asked, can pensions AVCs be passed on to kids if both I and my spouse pass away? Well, the AVC pot of money, Kyle, is covered by the expression of wish form you would have completed within your main local government pension scheme. So when you join that local government pension scheme, you would have completed that expression of wish form. Whoever you've nominated on that form would be the full recipient of your AVC pot of money in its entirety, typically as a tax-free cash lump sum. Now, if it so happens that you've nominated your spouse on that form and you and your spouse would, say, pass away at the same time, your AVC pot doesn't go anywhere. It just forms a part of your estate. Okay, so essentially that forms a part of whatever's in your will at that point. So, you know, that's how your AVC pot would be dealt with in that kind of scenario. William has asked, if I wanted to withdraw a salary sacrifice share cost AVC of £100,000, what level of tax will be payable? Well, William, it depends on how you want to take the benefits, because, you know, in theory, you know, it might be that you could take that whole £100,000 all back as a tax-free cash lump sum if you took your AVC at the same time as you took your main local government pension scheme benefits. There's always an upper limit. Everyone has different upper limits, and we can help you with that here at AVC Wise if you wanted to email us or book a meeting with us. But ultimately, as I say, in theory, if you took your AVC at the same time as you took your main local government pension, it could potentially all come back as a tax-free cash lump sum. Otherwise, if you wanted to, you know, take withdrawals directly from your AVC or transfer it into another pension arrangement, if you wanted to, the tax treatment there would be 25% tax-free, with the rest of it being added on to any other income that you're earning in that tax year to determine what tax you should be paying on it. And William has also said, can the share cost AVC pot be exhausted in your lifetime? Well, I mean, William, yeah, I mean, most people that have a share cost AVC, the most popular way people want to take their AVC benefits in retirement is typically taking the AVC pot of money at the same time as they take their main local government pension and taking that whole AVC pot of money all back as a tax-free cash lump sum. So as I said, there's always an upper limit to that maximum amount that you're allowed to hold in your AVC and take all back as tax-free cash. Everyone's got different upper limits in that respect. And we could potentially help you at a meeting there to define what your upper limit is by taking a look at what your projected pension benefits are going to be at retirement. So yes, a lot of people that are looking to save into an AVC and solely build up a pot of money that they just take all back in one go as a tax-free cash lump sum at the point they access their main scheme pension, there is always that upper limit, and therefore potentially you could overfund your AVC in that scenario. Otherwise, you know, some people aren't too fussed about that because they might be looking to use their AVC in different ways where they're not going to have that upper limit restriction effectively, apart from, of course, the overall government restrictions in terms of lifetime allowance and annual allowance. Okay, and Gordon said, thanks, that's been very helpful. No problem at all, Gordon. Glad you found today useful. And Yvonne said, I need to head off. Thank you. No problem at all, Yvonne. I appreciate we've probably run a little bit over time, so I appreciate those of you that have stuck around today. Okay, right, some great questions there. So thank you everyone for those. Okay, well, let's get today's webinar wrapped up for you then. So with the information we've covered today, you now hopefully have a better understanding of how your LGPS benefits are calculated on your pension statement and what this means in terms of what your LGPS benefits will be at retirement. And although the local government pension scheme is no doubt an absolutely fantastic arrangement to be in, you need to ask yourself, is it going to be enough to fulfill all the goals you have for your retirement? Is working to state pension age something you're happy to do? And if you would like to retire earlier, are you going to have enough money to bridge the gap and mitigate the costly actuarial reductions that can be applied to your main local government pension? The Shared Cost AVC allows you to save additional money for retirement in a remarkably tax-efficient way, and then have the unique opportunity only available to local government pension scheme members, where you can potentially take that whole AVC pot of money you've built up all back as a tax-free cash lump sum at absolutely no detriment to the benefits you're due to receive from your main local government pension. And the sooner that you take action and start to plan for your retirement, the easier it will be for you to reach your retirement goals. And trust me, your future self will be grateful for the action you can take today to make your retirement dreams become a reality. Thank you for your time today, everyone. I'll let you get off and have a great rest of the afternoon.